Well, welcome to our next segment on fixed income basic concepts, our first study session for fixed income. And here we have a reading on fixed income markets and how bonds are issued, a little bit about how they trade and funding their bond positions and bond trading positions. So let's jump into this, and as usual, we'll have a little bit of terminology and a little bit of detail for you. When we talk about fixed income classifications, we can classify them. Sometimes they are by type of issuer. They'll talk about government bonds versus corporate bonds or agency bonds or SPE, securitized debt securities. They can be split also by the credit quality. We talk about investment grade bonds versus high yield bonds, which is a nice term for junk bonds or highly speculative bonds. We also look at them by maturity. Of course, money market securities are a year or less in maturity, so that's really a different market in the way that it functions and the instruments that are available. And then we talk about the capital markets, maturities of more than 1 year, and certainly we still have a lot of variety there, but a lot of them being bullet bonds that you learned about in an earlier reading. We can also divide them by their coupon structure. Are we buying fixed rate bonds or are we buying floating rate bonds? So a lot of ways to look at them in different classifications. We can also look at the geographic market, developed country, developed economy bonds, emerging market bonds, or specific national bond markets. We can look at the currency denomination, of course. Bonds are issued in many different currencies around the world. We have index bonds, which we discussed a little bit earlier, indexed to inflation, maybe to an equities index or to a commodities price. And then the taxable status. Remember that in the U.S. we have these tax-exempt bonds issued by municipalities, original issue discount bonds. Remember we spoke before that movement from the discount price to the face value or maturity value is also interest and is taxable, even though there's no cash flows for that during the life of the bond, or at least those cash flows don't come until maturity. And there are some where interest is paid net of tax, but that's a fairly small category just mentioned here. Okay, let's talk about this interbank money market in LIBOR. We can define this as interest rates for unsecured lending between banks. So it becomes a reference rate, a reference floating rate. The most widely used one is LIBOR, the London Interbank Offered Rate. So these are the rates at which banks will lend funds to each other. And so the credit quality that's implicit in these rates is the credit quality of the multinational banks based in London that participate in determination of LIBOR. Now, LIBOR is quoted for 10 different currencies and 15 maturities from overnight to 12 months. So they're all money market rates, and they're all expressed as annualized rates. So other ones, Euribor, Tibor, Cibor, HIBOR, Coribor, that's Korea, HIBOR is Hong Kong, and so there's names for all of them for the 10 different currencies. So primary market for bonds. Primary market meaning newly issued, right? New borrowings, new issues. And one way to do it is a public offering. Certainly most of the large issues are done like that. The issue's registered with securities regulator. Other than a public offering, some bonds are not registered for trading with the public, so that's less hoops to jump through with the financial regulators, the financial authorities. In these private placements, they can only be sold to qualified investors. Now, that would be most institutions, and certainly wealthy people and smart people are qualified. And I guess the rule of thumb is if you're wealthy enough, you can hire smart people, so you qualify for a private placement. So these bonds cannot be sold to the public. So they either hold them to maturity, they can sell them to other qualified investors, but not to the public. But they're usually purchased with the idea of holding them until maturity. With a shelf registration, the entire issue is registered for public trading with the regulators, but they're not all issued at once, and that's so they kind of keep them on the shelf. And these are used in the bond market often to replace short-term financing with long-term financing, longer-term financing over time. So an entity like General Motors Acceptance Corporation, which makes car loans for people buying GM cars. Well, they do a lot of car loans. They'll fund this with shorter-term financing, but when they get to a significant amount, then they can take some bonds off the shelf and sell those to replace that funding, get more permanent funding in place, and then do that process over again. Now, an underwritten offering, this refers to the fact that the investment bank, or sometimes a syndicate of investment banks, a group of them, they actually agree to buy the whole issue and then resell it at the offering date. And they take on some of the risk if there's significant interest rate changes or anything during this process. They'll be at risk, but the guarantee to the issuer is that all the bonds will be sold at a given price. They know that going into the offering date. And sometimes bonds trade for forward delivery. So even though they're going to be issued maybe a few weeks down the road, they'll start trading. And they say trading when issued. Sometimes you'll see a WI next to the quotation on those. And what that means is, well, yes, I've sold you a bond, but I don't have to deliver it until the offering is completed and those bonds are issued and start trading. And that's sometimes called the gray market, but it really gives participants in the issue a good early look at what those bonds are going to be priced at, what kind of demand there's going to be, and things like that. As opposed to an underwritten offering, sometimes investment banks do a best efforts offering. And here they're sold on commission. They haven't promised to buy the whole issue. They've promised to sell as much of it as they can during this offering period, and that's why we call it the best efforts. And there's usually some sort of minimum amount that if that much is not sold, then the issue just does not go forward. And in the government bond market, we often see auctions as the way for issuance. And we'll discuss the various types of auctions in other parts of the curriculum, but for U.S. Treasury bonds, for example, they're always sold through auctions that are published well in advance and involve the primary dealers, and these are the bond dealers that deal directly with the U.S. Treasury on the issuance of new securities. Okay, so that's the primary market for bond. The secondary market, well, that's for used bonds, right? Bonds that have been previously issued. And this is primarily an over-the-counter market rather than an exchange market, or we refer to this over-the-counter market as dealer market. The bid-ask spread, the difference between the price dealers sell the bonds at and the price they offer for those bonds, depends on the issue's liquidity and is an indication of the issue's liquidity. Now, trade settlement in the secondary market, we've got T plus 3. Well, T is the trade date here, and plus 3 is 3 business days, so 3 days when the markets are open. So 3 days after the trade date is the settlement date. That's when the cash and the bonds are actually exchanged for corporate bonds. Is shorter for government bonds. It's T plus 1 for government bonds and quasi-government bonds, government agency securities. And same-day cash settlement for many money market securities, so our short-term securities. Same day, and what we call this is cash settlement. You make the trade, you pay the cash, you get the bonds, it all happens that day. And some government bonds trade that way as well. So let's talk about some government debt. When we speak of sovereign bonds, these are issued by national governments. Okay, so the UK, Japan, US, whatever. They're issued in the local currency, but sometimes they're issued in a foreign currency as well. A higher credit rating for the local currency bonds, and this is because a country that has its own currency, well, they can print that currency. So there's a higher probability that you're going to get paid, a lower probability of default, because they have the ability to either tax or print money to get the funds needed. If they issue it in a developed country's currency, so if a country issues bonds, sovereign bonds denominated in US dollars or euros, for example, well, they can't print those, and they actually have to come up with those in the foreign exchange markets. And so the probability of default is greater, and they get a lower credit rating than local currency sovereign debt of the same country, same issuer. What are non-sovereign government bonds? Well, just other parts of the government that are not national governments. So state or provincial government, county governments, various districts that may be created for the issuance of public debt, cities borrow in these markets as well. And these are paid from taxes or fees, or in the case of a project, they're often paid from the revenues of the project. So that's non-sovereign, but still government bonds. And certainly those markets are significantly different in the way they're traded, the liquidity, size of the issues, and things like that. So let's talk more about this agency or quasi-government debt. It's issued by government-sponsored entities. Now, sovereign debt, U.S. Treasury bonds, are issued by the Treasury, and we say they're backed by the full faith and credit of the U.S. government. Well, there's a little distinction that that's not true with Fannie Mae, the Federal National Mortgage Administration, for example. These may be guaranteed by a national government, but they may not. So in the case that they're not, there's a little gradation in terms of their ratings and default risks and yields between an agency security and a directly issued sovereign bond, but mostly those are small unless there's special circumstances, as we've seen with some of the mortgage bonds in the U.S. and other parts of the world in the late 2000s. When we talk about supranational bonds, they're issued by multilateral agencies. So agencies that are really not specific to one country. And two examples of this are the IMF and the World Bank, which are truly global organizations. So when they issue bonds, they're not national bonds, so we say supranational bonds. They are issued and cross borders at the time of issuance. And corporate debt. Very big corporate debt market in the U.S., not so well developed in other parts of the world. Sometimes they rely much more on bank financing than issuing publicly traded corporate debt. So when we have bank borrowing, we speak of a bilateral loan, and that's just a loan from one bank to one corporation. So there's two parties involved, but a single bank and a single borrower. With a syndicated bank loan, several banks go together and each take a part of the debt and diversify that way and manage their risk that way, rather than making a huge loan to a single borrower. Now, commercial paper, which is used for working capital and sometimes bridge financing, and bridge financing, just referring, as I mentioned before, with a shelf registration, is bridging from short-term funding sources to longer-term, more permanent financing, and put that in place. So in the U.S., commercial paper has maturities up to 270 days, and that the reason for that is that if they have maturities longer than 270 days, then they have to register the issue with the Securities and Exchange Commission. But if they keep the maturity short enough, 270 days or less, then they don't have to go through that registration process with the SEC. And commercial paper trades settle the same day, cash settlement T+0. Now, Euro commercial paper, similar, but maturities go up to 365 days, so just short of 1 year. And they're sold on an add-on interest basis, and they settle 2 days after the trade date, so T+2. And the difference here, the U.S. commercial paper is sold at a discount. So $100,000 face value, you're going to pay $99,218 for it, and it's going to mature in 34 days. And so that's what we mean by sold on a discount basis. With Euro commercial paper, it's an add-on basis. So you buy it at the 100,000, and then you get the 100,000 plus the interest added on at maturity. So a little difference in the way we do the calculations for it, but overall there's no real functional difference between the two. Commercial paper, it's short term, right? And one of the risks is what we're going to call rollover risk. And this is just the risk that the new paper can't be issued to pay for the maturing paper. They continually roll this over in the commercial paper market. Well, if something happens, either economy-wide or with the company itself, you could have deterioration of credit as well as a systemic failure, an economy-wide trouble that makes it hard to place this paper. I know during the mortgage crisis 2007, these markets just froze up. Well, the companies are really need that money in order to pay off the old debt. It's not like they expect to just retire it. So in order to keep the credit rating up and find buyers for this, firms have to have backup lines of credit or some other facility that mitigates this rollover risk. And a backup line of credit says that, well, if they can't roll it over, then the bank, whatever funder has issued this line of credit, will step in and provide those funds. But here's the caveat at the end. Funds are available unless there is a material adverse change. So if there's a material adverse change, like it looks like this company's not going to be able to pay this money back, then they can step away from this backup line of credit. But it does reduce rollover risk enough to get acceptable credit ratings for institutional trading. Here's an example of an add-on versus a discount yield. And we're going to consider a 240-day commercial paper with a holding period yield of 1.35%. And so the way we would price that at a discount, given that yield, is to divide, we're really looking at 100 here, we're looking at 100% of face value. And we divide that by 1 plus the interest rate. So then if we multiplied that, well, here it is right here, 98,668. If we multiply that times 1.0135, increase it by 1.35%, that gets us to 100% of face value, which is what it will pay at maturity. And then the discount, of course, is just the difference between those. Now, the yield that we use there, that's the effective holding period yield, right? We've got a 240-day period. We used 1.35%, and that's actually the effective rate that you would earn over that 240-day period. So we used that 1.35 as a holding period yield, not as any kind of an annualized yield. If it were an add-on yield, we'd pay 100% of par, and at maturity, we'd get 101.35% of par. So that's add-on yield versus discount yield. Some more about corporate debt here. We can have a term maturity structure, and that means the entire issue matures on the same date. Sometimes we'll see a serial bond issue, and this is also quite prevalent in the municipal bond industry. We talked earlier about a sinking fund where part of an issue is retired each year up until maturity. With a serial bond issue, it's a similar thing, but you know which bonds are going to be retired early because they'll take a whole issue and say, okay, we're going to sell some with a 7-year maturity, some with a 10-year maturity, some with a 12-year maturity, or even more evenly spaced than that. So taking a whole issue and cutting it up into various maturity dates so we have different bonds that comprise this whole thing, that's a serial bond issue. Medium-term notes, a little bit odd. They're not necessarily medium-term. They're not necessarily notes, but they do have some distinctive characteristics you need to be a bit conversant with. The issuer provides a range of maturities at which they will issue debt, and they give some indications of interest rates they're willing to pay at various maturities, and they're sold through an agent. Well, a buyer will come to the agent and specify, well, we need some 12-year bonds, okay, and we need 20 million of those. Can you do it? What rate can you do it at? And so it's really a continuous offering by the issuer's agent over time. Now, some of these medium-term notes have been very long maturities. I think Disney issued some 100-year bonds as a medium-term note facility, and so there's quite a range of things out there. They can be offered with various characteristics because the buyer is coming in and saying, hey, this is what really fits my needs. Will you sell, will you issue this debt? And what rate will you issue it at? If they come to terms, then they go ahead and complete the transaction. So, short-term funding for banks. Where do banks get their money? Well, they get it from customer deposits. A certificate of deposit that's a customer deposit too. They're just in denominations and they're for fixed periods, right? You can get a 1-year CD, a 2-year CD. There's also, beyond those, negotiable CDs that actually trade in a somewhat liquid secondary market. They can borrow funds from the central bank, okay? Or they can borrow funds from other banks, interbank funds, to fund their reserves, to make loans and do their business. And what's a repurchase agreement and why do we care? Well, repurchase agreements are a way of funding a bond portfolio in many instances. So it's a source of short-term funding for bond dealers. And the way it works, I mean, repurchase, that tells you the story. I'm going to sell you this bond and I'm going to promise to buy it back, and you're going to promise to sell it back at a higher price somewhere in the future. Could be as little as 1 day, could be as long as a year. Okay? Usually not that long, but these repurchase agreements are called repos. So we sell the bond and agree to repurchase it. We'll call that the repo date at a slightly higher price. If it's a 1 day, we call it an overnight, and if it's longer than 1 day to maturity or till the repurchase date, the repo date, then we're going to call it a term repo. A reverse repo, the dealer acts as the lender and buys a bond. And it's only a reverse repo. It's the same transaction. It's just now the dealer's on the other side of the transaction. That's what makes it a reverse repo. Why would the dealer do that? Well, the dealer might need that bond for delivery or something like that, and then hope to replace it later, or be obligated to replace it later on the repo date. So some terminology here. The repo rate is the percentage difference between the sale price and the repurchase price. So I sell you the bond at 90, I promise to buy it back at 91. What's that? 1.11%. So that's going to be the repo rate. So what it is, it's like the interest rate. Is you're making a loan and then taking a loan and then paying it back. The difference is the interest. In this case, it's the same transaction, except there's actually a sale and a purchase involved of the underlying asset. The repo margin is sometimes called the haircut. That's the percentage difference between the sale price and the value of the bond. So that's really a cushion, okay, for the bond buyer in the repo, because the values of these bonds can move around. And you don't want to loan more, pay more than the bond is worth, okay, and be in that position. So depending on the characteristics both of the dealer, the borrower of the funds, and the security itself, those are the things that can affect how big this cushion is of how much you're going to pay me. See, because the dealer would like to get as much as possible, but they're going to pay a little less than the value of that bond to give themselves more protection and, as I say, a little bit of cushion. So the haircut, so to speak, is to the bond dealer that's selling the bond and raising the funds. Well, both parties have counterparty risk as to whether the other party is actually going to perform under the terms of the contract. The security lender may experience financial stress. The security may decline in value. So these are all risks that are involved in these repo transactions. Here on this last slide, we look at the factors that affect the repo rate and the repo margin. You can think of the repo rate as the interest rate on the funds being loaned, and the repo margin as the safety margin to the lender of the funds. Well, both of those will decrease with higher credit quality of the collateral. They'll both increase with the term of the repo, but they tend to decrease when the security is in greater demand. That is, the lender of the funds would like to have the security, so would accept a lower interest rate and or a lower margin of safety. When delivery is required, the collateral is considered better quality and the repo rate is lower. And when the counterparty credit is better, this is also more safety and the repo margin is lower. So that's a little introduction to issuance and trading of bonds in financial markets, and we'll get some more detail in our next session.